pleasure.
Now, in the last week, Steve, we saw an upswing in the Kenyan market, and because of that, some profit taking by foreigners and locals flooding into the market. Are those trends continuing?
Basically, the market has seen impressive results the last couple of weeks, with foreign investors actually taking strong positions in terms of strengthening the portfolios and cashing in the capital gains, while local investors actually hold back and see how the political situation in the country is going to be. Also, we've seen that one of the leading shares of the market that has been dominating in terms of trade, Safaricom, we've seen that its portfolio holding for foreign has actually gone up, and which I believe this is a good thing, because at least the market is actually segmenting itself into proper drive with the essence of understanding proper marginal depreciation for prices that have been high, and looking forward to proper understanding by foreign investors, because at the end of the day, foreign investors are the ones who actually making the drives at the market.
All right, let's talk about equities versus bonds. Even though returns on bonds are at about 10%, the yield's lower, there seems to be a lot more interest in the bond market. Why is that?
I mean, at the end of the day, equities have better returns, especially when you're having a bull market, or especially what the market has been for the last couple of weeks. However, the reason why the bond market in the country is actually doing very well is, one, because of the aspect of investor confidence. Because at the end of the day, given how the market shared a lot of points in terms of growth in the last 2 years, the equity market where investors lost almost up to 47% of the investment. Many people have opted to go for the bond way, because, one, they'll be assured of at least a fixed return percentage on the investment, and secondly, the aspect of security for the investment, because they know at the end of the day they're dealing with a government-related security. So the aspect of a broker closing down or going down with the money is not an issue. So they've got the safety of their money and then, guaranteed return. All
right, still staying on equities, Steve, they've become very expensive, as you're suggesting, and that's why people are reticent to move into equities at the moment. I mean, a rise of 31% within that particular continuum. But it's also expected to have an impact on competitive returns for dividends. Do you concur with that view?
No, I don't, because, one, I don't think equities have become expensive, because when you look at it, our market has actually been recovering. The market shared 47 points in terms of value. So if we've picked up 31 points, when you look at the difference, you still have at least around 15 points to go before you can actually go back to our former position where we were. And then from there, we can now talk about proper appreciation of the equity market at the stock exchange. But what I believe in, at the end of the day, dividend yield has really gone down, because, one, many of the companies have had business issues. The profits have been dwindling. There have been a lot of strategy in terms of growth, and the aspect of dividend yield is actually pegged on how strong or weak the share is actually doing at the market. So the higher the share price at the market, the better the dividend yield. And one of the leading companies is the tobacco one, and you've seen that its growth has actually gone down. And one of the leading companies in terms of controlling share capitalization, which is Safaricom, we've seen that its share price has never gone beyond 6.8 shillings. So if you're a serious investor in Safaricom, you realize that your dividend yield from Safaricom will be very minimal. So you'll be looking at cashing in more on price appreciation and marginal difference than looking at the dividend yield at the end of the day.
All right. Now, earlier on, we were referring to how the shilling often tracks the euro, and there are questions being raised right now with these European stress tests being conducted by the ECB on 91 banks, an attempt by the ECB to shore up confidence in the euro. Has it had any impact from your assessment on the shilling? Are you monitoring events in Europe at this stage?
What I know is the relevant stakeholders are actually monitoring what's happening on the European markets. However, the unique aspect of our markets is that in as much as we are interconnected with the global markets, and especially we've seen how our shilling has been weakening against the principal currencies, the dollar, the euro, and the pound. What I know is the effect of the stress tests has yet to actually get here, and that's why our shilling is still trading, in the levels of 80 to 81.40 cents. The reason being is normally, when the European or the American markets sneeze, we end up coughing much later. So I believe that the results or the effect of this will actually be getting to us probably by the end of next week or towards the beginning of August. So I know there'll be a positive impact, but normally the issue is the result. the causation effect takes a bit longer to actually affect our market.
All right, always great having you.